So Netflix just dropped their fourth quarter earnings on January 20th, and honestly, it's a really interesting one. On paper, the results looked fantastic, but the market's reaction? Not so much. It's this weird conflict, you know? Great performance hitting a wall of investor anxiety. In this breakdown, we're going to dig into exactly what went down, why it happened, and what it all means for Netflix going forward.
All right, here's the game plan. We're going to start with the headline numbers and the stock's pretty surprising reaction. Then we'll get into the guidance, the forecast that really seemed to spook everyone. After that, we have to talk about the massive $83 billion question mark hanging over the whole company. We'll also see what management's plan is beyond that big deal, and then I'll give you our take on what to watch for.
Okay, so first up, let's get right into the core mystery here. The results for the quarter were solid, no doubt about it, but the market's immediate reaction? Well, it told a completely different and way more negative story.
This is the number that kind of says it all, right? In after-hours trading, that's right after the market closes, when the first real reactions happen, Netflix shares tanked by almost 5%. That was the market's first and very loud verdict on the whole announcement.
Now here's why that drop is so confusing. Netflix actually beat Wall Street's expectations. I mean, look at this. Earnings per share came in higher than expected. Revenue also beat by a good $80 million, beating on both the top and bottom line. That usually sends a stock up, not down. So, what gives?
Right, so here's the key. The market wasn't really punishing Netflix for what it just did. It was reacting to what Netflix said it's going to do. See, investors are always looking ahead, and the forecast they saw just gave them a serious case of the jitters. And this slide just lays out that conflict perfectly. On the left, you've got the past, Q4, really strong performance. Revenue up almost 18% year over year, operating margins looking good. But then you look to the right, at the future. Their Q1 earnings guidance was seen as a little light, and that full-year margin number, well, it came with a big asterisk next to it.
And management was really clear about this on the call. That 31.5% margin target for 2026, it actually includes a 0.5% drag. And that drag is coming straight from the expenses tied to a huge pending deal. So let's get to it. The biggest factor weighing on the stock, the elephant in the room for the entire earnings call, was this absolutely enormous pending acquisition of Warner Bros.
Just look at that number, nearly $83 billion, and it's an all-cash offer. To put that in perspective, that's more than the entire value of a lot of huge, well-known companies. This is a massive, company-defining bet they're making. And a bet that big, well, it brings a huge cloud of uncertainty. I mean, how are you going to finance an all-cash deal that size? To save up cash, they've already had to pause their stock buyback program. And then you've got the regulators. Is the government going to see this as a monopoly and try to block it? These are massive, unanswered questions for investors.
Faced with all that doubt, co-CEO Ted Sarandos came out swinging. His argument is that this merger isn't anti-competitive at all. He's saying it's going to be a win for everybody, from you, the viewer, to the creative people actually making the shows.
They're really trying to frame this as just pouring jet fuel on what they already do best. They're calling it a strategic accelerant. And to back that up, they're saying that even after this massive deal, 85% of the new company's revenue will still come from the core Netflix business we all know today.
So, beyond the Warner deal, management was really eager to remind everyone that their core business is still incredibly strong. They wanted to make it clear that even without this huge acquisition, the growth story at Netflix is very much alive and kicking.
And a huge piece of that story is advertising. After hitting $1.5 billion in ad revenue last year, they're forecasting that to basically double in 2026 to around $3 billion. That is a seriously powerful revenue stream that's really just getting warmed up. And it's not just about ads. Netflix is pushing hard into all these other areas to keep you engaged. They're doing more live events, they're launching video podcasts, and they're building out a cloud gaming strategy, which is a really clear shot at that huge gaming market. It's all about keeping you inside the Netflix world for longer.
So let's put it all together. What does all this mean for the stock? And what should we be watching for over the next few months? Let's wrap this up with our forward-looking take.
So here's our thinking. In the short term, everyone's going to be watching to see if Netflix can hit their kind of cautious Q1 numbers. The stock itself is probably going to be range-bound, which just means it'll likely trade sideways, not making any big moves up or down until we get more clarity on that Warner deal. Because of that, our rating is market perform. It's really a classic showdown between strong fundamentals and this giant wall of worry from the acquisition.
And hey, just to be crystal clear, this breakdown is for informational and educational purposes only. This is not financial advice.